Hello, and welcome back to the channel. I'm Algabot, your guide to the world of automated trading strategies for MetaTrader 5. Today, we're taking a close, educational look at an expert advisor called Relative Volatility Index Breakout. This strategy is built around a lesser-known oscillator created by Donald Dorsey, one that measures the direction of volatility rather than the direction of price. Over the next few minutes, you'll learn how the indicator is constructed, how the expert advisor decides when to open and close trades, and how it manages risk. Let's explore how this trend-following momentum approach works, step by step. So what exactly does this expert advisor do? At its heart sits the Relative Volatility Index, or RVI, a tool designed by Donald Dorsey in the early 1990s. Most oscillators, like the popular RSI, track whether price itself is moving up or down. Dorsey's index does something different. It measures whether volatility, the size of the market's range, is expanding on up moves or on down moves. Two markets could show an identical RSI while one is expanding on rising days and the other on falling days. The RVI tells those two situations apart, and that distinction is the analytical edge this strategy aims to study. The index is built from a rolling standard deviation of price. That volatility figure is split into an up move stream and a down move stream, each smoothed using Wilder's method, and then combined into a single reading that oscillates between 0 and 100 around a midline of 50. A reading above 50 suggests the range is expanding on up moves, which the strategy treats as bullish volatility. A reading below 50 suggests the opposite. This expert advisor is designed for liquid, trending instruments such as gold or major currency pairs, typically on the 15-minute or 1-hour time frame. It follows a trend-following momentum style, meaning it aims to join a move that is already underway rather than predict a turning point. It suits a trader who is studying how volatility-based filters can be layered together and who is comfortable with a rules-based, fully mechanical approach. Remember, this is educational information only and not financial advice. Every strategy, including this one, carries real risk, and losses are a normal part of trading. What we're doing here is understanding the logic, not making any promise about outcomes. Let's walk through the exact rules this expert advisor follows. First, it only acts on fully closed bars, so it never reacts to the noise of a still-forming candle. On each new bar, the strategy recalculates the refined RVI, which is the average of the index computed on the highs and the index computed on the lows. Rather than simply reacting when the RVI crosses the 50 midline, which would produce a lot of false signals in flat markets, the strategy uses a hysteresis breakout. This means it waits for the index to clear a band around the midline. For a long, the RVI must break upward through the upper threshold, set by default at 55. For a short, it must break downward through the lower threshold, set by default at 45. Between those two levels, nothing happens, and that dead zone filters out much of the mid-range chop. But a volatility breakout alone is not enough. The strategy adds two honest confirmations. First, the signal bar must close in the direction of the trade. For a long, the candle must close above its open, showing that price actually committed upward, not just that volatility flickered. Second, a slow trend filter, an exponential moving average with a default period of 100, must agree. The expert advisor only takes the long when price closes above that moving average, and only takes the short when price closes below it. This keeps every trade aligned with the prevailing drift instead of fighting it. So a complete long setup needs three things at once: the RVI breaking up through the upper band, a bullish closing bar, and price above the trend average. The short setup is the mirror image. Now for exits. Every position carries two protective levels based on the average true range, a common measure of volatility. The stop is placed at 2 times the ATR away from entry by default, and the target is placed at 3 times the ATR. That fixes the reward-to-risk relationship and lets it scale automatically to any symbol or time frame. There's also an early exit. If the RVI crosses back through the 50 midline against an open position, the strategy closes it, because the volatility that justified the trade has flipped. Only one position is held at a time, with no adding to winners, and order size is normalized to the broker's lot limits. Let's look at the actual MQL5 code that runs inside MetaTrader. At the top you can see the input parameters, the settings you can adjust in the strategy tester, or on a live chart. STD period, set to 10, is the look back for the rolling standard deviation that feeds the index. RVI smooth period, set to 14, is the Wilder's smoothing length. Upper threshold and lower threshold, 55 and 45, define the breakout band. ATR period, StopLossAtr, and TakeProfitAtr control the risk levels, and TrendEmaPeriod, 100, is the trend filter. Just below, two Boolean flags do the core detection. Cross-up is true when the previous RVI reading was at or below the upper threshold and the current reading is above it. Cross-down is the reverse, true when the RVI drops from at or above the lower threshold to below it. Now look at the long block. The condition reads, if cross-up and the bar is bullish and price is above the EMA. When all three are true, the code reads the current ask price, sets the stop-loss 2 ATR below entry, sets the take-profit 3 ATR above entry, and calls trade.buy with a normalized volume. Every value is rounded to the symbol's digits, so the broker accepts it cleanly. The short block, just below, is the mirror. If cross-down and the bar is bearish and price is below the EMA, the code reads the bid price, places the stop 2 ATR above entry, the target 3 ATR below, and calls trade.sell. Notice how both sides share the same structure, just flipped in direction. That symmetry makes the logic easy to read and easy to reason about, which is exactly what you want in a mechanical trading system. Now let's bring it all together on a chart and watch the strategy trade, candle by candle. On the price panel, you can see the candlesticks and the slow trend exponential moving average, the blue line, weaving through them. Below, in the subpanel, is the Relative Volatility Index itself, oscillating between 0 and 100, with the upper threshold marked at 55, the lower threshold at 45, and the midline at 50. Look at the first few candles on the left. Price is drifting sideways in a quiet base, and notice the RVI down in the lower region, below 50. Volatility here is leaning slightly to the downside, but crucially it has not broken through the lower band cleanly, and price is coiling rather than trending. The strategy simply waits. This patience is the whole point of the dead zone between the two thresholds. Then watch what happens on the fourth candle. Price pushes up with a strong bullish body that closes well above its open, and at the same moment the RVI climbs and breaks upward through the 55 level. That is the volatility turning bullish, the range now expanding on up moves. Two of our three conditions are met, and because this candle also closes above the blue trend average, the third condition falls into place too. All three align, and the buy entry marker appears. The expert advisor opens a long position, immediately placing a stop 2 ATR below the entry and a take profit 3 ATR above it, a reward to risk of 3 to 2. Now follow the next candles. Price presses higher, one bullish bar after another, and the RVI stays elevated above the midline, confirming that the up move volatility is holding. The move runs cleanly into the take profit target on the seventh candle, where the position closes for a completed trade. Notice we never needed the midline exit here, because price reached the target first. That is the ideal outcome the structure is designed to study. Enter as the range expands in your favor, then let the fixed target do its work. After the peak, the picture changes. Price stalls, then rolls over. The trend average, which had been sitting below price, is now caught above it as price slips lower. Watch the RVI fade from the upper region back down toward the midline and then keep falling. On the 10th candle, the short setup completes. Price prints a firm bearish candle that closes below its open, and the RVI breaks downward through the 45 level, signaling that volatility is now expanding on the down moves. Because this candle also closes below the blue trend average, all three short conditions are satisfied at once, and the sell entry marker appears. The expert advisor opens a short position, this time placing the stop 2 ATR above the entry and the target 3 ATR below. From there, price works steadily lower. Each new candle carves out a fresh low, the RVI stays pressed beneath the lower band, and the down move volatility remains dominant. The decline reaches the take profit target on the final candle, closing the short trade. Once again, the trend filter kept us on the correct side of the move. The closing bar confirmation made sure price had actually committed, and the volatility breakout timed the entry to the moment the range began expanding. That is the complete cycle, a long taken as volatility broke bullish in an uptrend, and a short taken as volatility broke bearish in a downtrend. In both cases, three independent filters, the volatility breakout, the committed closing bar, and the trend regime, had to agree before a single order was placed. Stacking those filters is how this approach aims to sidestep the mid-range chop that troubles so many oscillator systems. Of course, not every real setup resolves this cleanly, and losing trades are a normal part of any strategy. Let's wrap up what we covered today. We explored the Relative Volatility Index Breakout Expert Advisor, an approach built on Donald Dorsey's Volatility Direction Oscillator. We saw how it waits for the index to break through a band around the midline, how it confirms each signal with a committed closing bar and a trend filter, and how it manages every trade with ATR-based stops and targets, plus an early exit when volatility flips. Remember, everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation. Trading always involves risk, and losses are part of the process. If you found this breakdown helpful, please like the video, leave a comment with strategies you'd like analyzed next, and subscribe for more MT5 strategy studies. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.